After a brief rally, how long does it take for stocks to truly bounce back? We'll talk about that on today's Lowdown. Everybody, welcome in. I'm Michael Smith, and joining me, Chris Roberts. Well, lots have happened here. We had a big rally here in July, and briefly into about halfway through August, and of course that changed course. And I think one of the big reasons it changed course is Jackson Hole, which, if many are not familiar, that's a famous speech where the Fed chairman comes out and it kind of gives his outlook for the remaining part of the year. And I can tell you, out of all of the Jackson Hole speeches I've heard in the past, this was one of the most hawkish, and meaning hawkish is aggressive. An aggressive tone by Jerome Powell. He's our Fed chairman. And he says some things that pretty much have scared the market. And I think everybody's seen now we've gotten a pretty big pullback. And by the way, on the last Lowdown, I did warn against the bullish sentiment. We had a lot of people bullish after that rally. We said, let's be careful, let's not get too excited. We could possibly see some volatility in a pullback or a retest of the lows. I'm not sure if we're heading there, but I can tell you what, we're setting up for a lot of choppiness from now to the end of the year. So Jerome Powell came out and he used the word pain. He's going to inflict pain, the housing market, the stock market, all these things. And one of the biggest reasons why is that I think if you look at the past of what the Fed's done, they've had two major mistakes, right? Transitory about inflation, and then of course the duration of this and how severe it's going to be. And of course now I think the embarrassment of getting it wrong a third time, they are now committed, in his tone at the Jackson Hole speech, they're committed to getting inflation to 2%. They don't care what they break in the way. And I think, quite frankly, that's what the market is reading now. That's why we've gotten the pullback, is they believe the Fed is going to raise rates now where we thought it was a pause. We're going to see rates raise until they break something. And that is a scary position to be in. Now, ultimately, the reality of that, we can talk a little bit more about that, but the reality of them actually doing that to get the 2%, that's pretty severe, And so I think if anything, probably from now to the end of the year, we're going to have this hawkish tone, and we'll see some volatility. But one of the big questions, Chris, and you and I have been getting questions from lots of our clients, and people that we talk to, is in regards to these types of rallies, how long does it typically take for stocks to snap back? And so I had a good chart here, and I thought you and I could talk through this. What exactly is this, this chart? Well, number one, the chart's the 10 worst market drawdowns since 1960. So you can see all the different, causes here. And if you look, one of the things I think that's really important to look at is looking at the average drawdown. So we got about a 35% average. The number of months to hit bottom's about 12, right? And if you look at the kind of the break even being 24 months, but here's one of the things, because we get this question all the time is, well, Mike, what if we go to cash? Or Chris, what if we go to cash? Or should we sit this out? Should we try the time to markets? And you and I have been talking, the narratives have changed much quicker. We went from inflation to recession to a market rally within literally probably 3 months, couple months span. So I think if you look at this further on the chart, what happens after the 6 months of hitting the bottom, you see a 30% rally on average, 1 year after 44%. So, you could clearly see if you miss that bounce, a lot of that gain could be in that front end. And if Powell is to come out later on, whether it's this year or next year, and they do change the tone from the hawkish to dovish, you could see a pretty big snapback. And so I think that's why it's important to kind of highlight this chart. But maybe you got some comments here as well.
Well, just like you were saying, that column right there where it shows the 6-month returns after we hit the bottom is really the most important thing. And I know we've shown the 10 worst drawdowns since the 1960s, but let's focus on the great financial crisis and the COVID-19 pandemic. That's a 52.75% rally off the bottom in the great financial crisis, and that's a 44.5 or thereabouts percent rally off the COVID-19 pandemic bottom in March of 2020. So that lends way to what you're saying, right?
Yes.
The narrative has changed in a manner where, these recoveries are happening a lot faster. And that kind of goes back to one of my core theses about things like free flow of information and, algorithmic trading and whatever it might be. But regardless, it makes it incredibly difficult to time these moments, right? And ultimately, what's going to happen to investors if we try to time this or overtime this and pick that bottom and ride that 6-month rally is that there's going to be fear of missing out. You're going to miss, let's take the COVID-19 pandemic, for example, you're going to miss 20% of that 44% rally off the bottom within the first 6 months because you're like, think back to March and April April, May of 2020, market was doing great, but I mean, the overlying economy was awful.
Absolutely.
You know, and so as an investor, you're like, man, I know the economy sucks, but the market's going up, and then if I go in and it goes back down, right? That's all. We got to cut out FOMO, right? And that's why we always talk about making financial planning driven investment decisions, right? It's sticking to a financial planning driven asset allocation and sticking to your guns. And I think we've got a really great chart that follows this one that really emphasizes that. And we'll flip to that one right now. And, you know, we like to use great information from all sources here at Avidian. This is a great chart from JP Morgan. I'm going to highlight, you know, two columns that are in blue right here. You know, so this is the 20-year annualized return. So average annualized return for a traditional 60-40 and a traditional 40-60 portfolio. You notice that's 7.4% and 6.4% respectively. But look at this orange column over here. The average investor in that same 20-year period did about 3.6%, right? And so that goes to show that, well, if you just stick to your guns and you ride these events out and you stick to your planning-driven asset allocation, you'll likely come out better in the end. Now, we've talked a lot on this show about how the traditional 60-40 or 40-60 portfolio is largely dead going forward, right? You need to diversify that further. You need to bring in non-correlated assets, alternative assets, any kind of strategy you can get your hands on to diversify your growth streams and diversify your income streams. But on a backward-looking basis, this shows us that those who stay invested reap the benefits, right? And those who do not, those who are reactionary, those who are emotional, they end up in this orange column right over here, and these average investor, and they end up with, you know, half as much return as they could have had.
Chris, I've got countless stories of clients that held a lot of cash after the great financial crisis. I mean, for many, the scars of the great financial crisis still, you know, they still reign with many people. And anytime you have market volatility, you see where those scars kind of bring that back up, that fear. And so you're absolutely right. Looking at that orange chart there, what investors have done since then, that's because many probably paused, didn't get reinvested. They exited with no clear plan of reentry. So again, back to your, you know, your thoughts there. I mean, one of the things we do here with all of our clients is making, you know, financial plan based investment decisions. And that's why it's so important to do that. It cuts the emotion out of everything else. And quite frankly, I talked about the Fed and some of the things and the volatility between now and the end of the year. Well, I think that's probably the number one creator of volatility. But what are some other thoughts you have on some things that we should be listening to that are going to create some volatility going forward?
Exactly, Mike. You know, we've talked a lot about the Jackson Hole speech, and that's certainly been the catalyst, you know, truly for the sell-off we've seen really since the rally peak since August 15th, right? It's been pretty precipitous, you know, these last 15 trading days, it's been, or 15 calendar days, has been, you know, quite jarring, so to speak. But then there's other things that, much like in the pandemic, you know, where bad news was good news, well, now good news is bad news for stocks, right? You know, consumer confidence continues to remain very, very high as inflation, you know, potentially peaked back in July. The job market, as of today's numbers, we've got a 9-week high in jobless claims, or I mean low, 9-week low in jobless claims. You know, that means the job market remains very tight. All this means tighter credit conditions, and it reinforces what Powell said during that Jackson Hole speech, which they're saying, hey, the macroeconomic data says the economy is still very strong, so it's going to be hard to get inflation under control. However, and one thing you kind of alluded to, but I'd like to reemphasize, is that the Fed is using backward-looking data to make forward-looking decisions. And that's what investors are so scared about, right? It's the idea that they will over-tighten and create a very bad economic outcome for everybody, right? And that's because, again, they're using backward-looking data. Typically, it's the Fed's role to be proactive, to be forward-looking, and in this case, we're using a lot of backward-looking data to make forward-looking decisions, and we're really sticking our stake in the sand, so to speak, on inflation, right? That's really the only economic metric they're focused on. But that's, again, that goes back to credit conditions. We've talked enough about credit conditions and tightening and what have you. But there's other things going on. I think you had one more thought. Maybe
I was to say that's scary, you know, looking at single data points. I mean, you and I both know this, and I think most of our clients understand this. I mean, post-pandemic, the market's a difference. I mean, we're not going back to what, you know, the world, the economies looked like prior to. It has significantly changed. And I think for looking at data points that might have been very reliable indicators, you know, prior to the pandemic, I'm not saying they're not reliable now, but they should not be the only things that are being looked at. And it is scary when we're looking at backward-looking data. I think a combination of that with some forward-looking data and making some assumptions is going to be critical.
Yeah, and you know, when you say that, you know, talking about, you know, how do you evaluate markets, I love that comment because, you know, in some respects, we have a little bit returned to normalcy with this rising rate environment, right? In that, you know, it's easier to evaluate, you know, stocks, bonds, and all asset classes when they're more fairly, when not everything is overvalued, right? January 1st, 2022, every asset class is overvalued, and it seems like everything's disconnected from fundamentals, right? Well, now we're starting to get a little bit more connection towards fundamentals again, and that should be confidence inspiring for investors, because that means they can make fundamental based investment decisions, not just like riding the next meme stock wave or something like that. But let's talk about some of these other risks, right?
Sure.
The things that we're watching besides what Powell says and gets up there and jabbers about. Geopolitical issues, right? And it's not just what's going on with Russia, right? Ultimately, we know that Russia cannot sustain a prolonged conflict in the Ukraine. They cannot sustain what's happening right now. Well, they'll try to do it as long as they can. But let's also talk about conflicts with China. That was the latest news story that really broke last night, was that the United States was going to ban companies like NVIDIA, AMD from selling chips to China specifically for the development of artificial intelligence technologies. That's both a national security item. It's also a trade restriction item. But the next, true warfare landscape is cyber warfare.
Yes.
It's also who can get their hands on the latest tech goods to get the upper hand on their competitors, on their adversaries. And that's precisely why we're doing that. But China's not going to be happy about that. The one thing that they lack is the ability to really produce very high-level technological goods. They can produce, mass produce items, but they can't necessarily produce the latest NVIDIA graphics card or whatever it might be. So that's a very big issue. Sticking with China, we've also got Chinese lockdowns again, right?
Yes.
That was a big story that came in. We've got another big industrial regions of China, industrial cities locking down because they had one single COVID case. That has been a continuous risk throughout the year. Every single time they say, oh, we're locking down Shanghai, you get big dips and all that.
That affects the supply chains.
And it affects supply chains, and it prolongs the inflationary problem that we're having. And then moving away from China, you've also got some technical stuff, right? And I think you touched on it in the last show, but this last rally literally bounced right up against that 200-day moving average. And that goes back to some of the things I was saying about algorithmic trading and technology. I saw a great analysis from somebody I follow very closely, and he was like, or they were elaborating on the fact that there could potentially be a wave of capital enter the market if we can break through that 200-day moving average. And so we got right up on it and just moved right back down off it. So that wave of buying hasn't quite come in yet, but I think that's a really good catalyst too. And it just shows that how many quants are really controlling the market, and ultimately if we break that point, that could be a really good sign that we're, going back to that 6 month after the bottom chart, that could be a really good sign we're going to propel higher.
Now, if the Fed does come out and change their stance to some degree, I think that's a big catalyst that could break us through. I mean, keep in mind right now, the consumer is very important, and housing is such a big component of the consumer psychology. And if you look at some of the housing data right now, I mean, you look at new family home supply, it's surging 10.9 month lows. I mean, we've seen that as far as, not many people or not many new homes being created. The housing supply of the existing homes, I mean, not many people buying. I mean, obviously interest rates are lower, but the Fed being so hawkish, and they intend to break housing as well, that ultimately affects the consumer, which is the biggest component of GDP.
Well, and housing trickles into everything. Why people always focus on housing when it comes to consumer confidence and things like that is that there's a lot of industries that surround housing, right? Everything from cleaning the home to taking care of it to plumbers, electricians. There's an entire economic sphere, if you will.
Yes.
Sorry for that. That surrounds housing, right? So as housing slows down, as there's less activity, less velocity of money within housing, that really affects a lot of different people in a lot of different industries. It's not just the realtors of the world and things like that. So I think that in some respects, the run up in values we saw at the end of in 2020 and 2021 was really a factor of lack of supply and everybody trying to move at once, low interest rates, all that coming together at once. And now we're just seeing that the opposite, right? Anytime something boils up, it's going to boil over. And ultimately that's going to create some opportunity for some people who didn't buy before to buy in the future too. So again, this is all very cyclical. But I think that, as we know, home values probably went up a little bit more than they needed to, largely supported by the Fed free money. And, we're going to continue to ride that cycle.
Fastest rise, homes typically do not rise more than the rate of inflation over the long term. So that was a big move and lots of room to kind of pull back. But the Fed is intent on getting inflation under control at the cost of everything else.
If you can slow housing, you can slow inflation. And that's what I mean at that entire economic sphere. You can slow housing, you can slow inflation. And so, and then, in thinking about, just some other risks that we've been watching or things that at least I've been watching really closely apart from for example, what Powell's been saying, like I was saying, is we have a significant energy crisis, not only in Europe, but here domestically as well. That's kind of a trickle effect of what's been going on in Europe. And it's not just what Russia's doing and limiting their exports of natural gas to, developed Europe. it's record heat, it's record droughts, it's a lot of these things. For example, we can't run hydroelectric plants out in the deathly hot, western part of the United States. Same thing's happening in the Northeast. We can't cool nuclear power plants, in generators. And so, because of all of that, we have a significant energy issue both in Europe and in the United States, partially because of what's gone on in the weather and things like that. But then also, think about it this way. Someone has to meet that demand overseas when it comes to things like natural gas supplies and things like that. We've seen natural gas here domestically hit $10 the BTU or whatever. I mean, that is incredible. That is absolutely incredible. And I think that that's probably going to persist so long as there's high demand in the United States. And plus, we're going to have a lot of high demand within our borders simply because we can't produce that power the way we were with hydroelectric, nuclear, and things like that. So, I've seen stories about rolling blackouts, things like that. That's kind of the fear side of everything.
It could be a new reality.
It could be a new reality, but ultimately it creates a lot of economic anxiety and inflation pressure, and it clamps people's pocketbooks because my electric bill's higher.
So you mentioned the drought, you mentioned the heat. The other flip side of that is going to be the winter that may come in. I mean, Germany's been stockpiling gas. Many
as much as they can.
Many say it's only enough if it's a mild winter. So what happens if it's worse? So again, back to a lot of your point is we have a lot of things that could create volatility. Obviously, the Fed at the forefront of that. I'm going to be stepping out. I'm finally taking that vacation for many of those that know that I broke my leg. I'm actually up and walking around, and so looking forward to taking that. So I think you're going to come in and do couple shows, keep everyone informed of what's going on.
We're going to try to get some new faces here on the show. I think we've floated the idea around the office. I think you guys are going to enjoy seeing some people that aren't typically, you don't hear from on our team or aren't even on our team that we want to bring into the show that I think are going to be a great, get some great insights as we go into September. So thanks for having me on, Mike.
Absolutely. We're looking forward to, Chris, you coming on, and the guests are going to be here, and I'll be back shortly, and we'll be seeing you soon. Take care.